Hey guys, it's Stephen Warner with Lawn Buddy. I'm super excited to dive into today's masterclass all around financing for your business. So let's go ahead and we'll jump right into it. So we have three different categories that I like to break down financing options into. We have the DIY, the do-it-yourself. We have your traditional loan, and then you also have angel investing down here. So first off, let's hit do-it-yourself. Right, so when you're looking at financing your business, whether that's for equipment, whether that's for employees, a new office, anything like that, my preferred way for financing is always going to be using the capital that you have in your account. And what that means is basically the money that you have in your bank account. Can you afford to pay for it with cash yourself? Because you're not paying interest on it, which means you're paying the true value of the product that you're actually acquiring. Whether that's people, whether that's equipment, anything you can think of, always defer to do it yourself first. Now, there are ways that you can leverage other things, especially if you're looking to grow rapidly, and one of those processes is a loan. So there are a lot of different loans that you can go out and apply for. Today specifically, I'm going to be talking to you about some SBA loans. And SBA is the Small Business Administration with the federal government that has developed loan programs with specific banks that are in your community to make small businesses more successful. So there are three that we're going to talk about in particular today, but if you have anything that you want to research on them, it's sba.gov, and we're going to link below here in the description, quick link so that you can go and see specifics on what these three programs are. So the first program we're going to talk about is PPP, second one is EIDL, and the third is a microloan. So let's start with PPP. I know what you're thinking, right? It's super complicated. You're going to go to this website. What the heck is PPP? And I'm going to break it down into some simple steps to where you can walk through and see if this fits your business. So PPP stands for Paycheck Protection Program. If you go to the SBA's website that we'll link below, it's just going to be a bunch of information on the guidelines of the loan. But what you're going to have to do is you're going to have to go out to a local bank and work with them. So if you Google SBA approved banks in your area, it'll come up with a list of them. Pick your favorite one and you can work with them, and you have to call them. So call them and ask to talk to someone about a PPP loan, and they'll put you in contact with the right department. Every bank has their own version of the format, but it's typically going to be about 4 pages long. Super basic information you'll have to provide for them. But the benefit of this is it's actually forgivable. So as long as you spend the money on the right things, payroll primarily, and you don't buy a boat with it, it's forgivable, which means you can submit to the government and it's treated somewhat like a grant and you don't have to pay it back. Now, if you decide that you want it to be a loan, then it's 1%, but your banking partner is going to be able to work with you on that. Same thing on the forgiveness. Before I jump into EIDL, you have to work with the banking partner. So as soon as you get the money, your bank will actually give you a list of things to start providing once you spend the money for you to be able to submit for forgiveness. So that's really important. Next, we're going to move on to the EIDL, which is Economic Injury Disaster Loan. Very similar to the PPP, but it is a traditional loan. Same thing though, you got to call your bank. So the same process that I outlined for PPP, find that list of preferred banks by the SBA and give them a call, and they'll be able to work with you to process that as well. Typically those interest rates are going to be around 3.75%, which isn't great, but still really good. Angel investor. So this is the last topic I want to talk about. So this is if you have a wealthy friend who wants to become a partner in your business, meaning that they want to join forces with you, they're going to purchase into your business, and that depends on how your company is legally structured. So what I mean by that is, are you a sole proprietor, meaning that you haven't really filled out any paperwork to become an official business? It's just kind of you, all the money's going into your bank account, or are you structured as an LLC, which is a limited liability corporation, which just means you have formal business structure. It reduces your risk as a business owner actually. And we have videos up on our Lawn Buddy YouTube page going into the benefits of sole proprietor versus an LLC or a C corporation or S corporation, if you have more questions on that. But essentially what the angel investor is doing is, let's say Stephen's Lawn Care is structured as an LLC, right? And I'm the only owner, which means I own 100% of the company. Let's say James wants to buy into my company. Let's say he has $50,000. I can say, I would sell 5% of my business, or whatever is a warm fuzzy for you guys on what you think the business is worth for that amount of money. So then James would write me a check for $50,000. There'd be a legal agreement that goes into it. Work with your lawyers. This is not legal advice or financial advice, but work with them so that way they can make that process seamless. But essentially what that's saying is you get the $50,000 similar to how you would with a loan, but it does come with interest rate just in the form of distributions or other ways that you have to pay that investor back, because it's not your money, which is why I always go back to do it yourself, because then you control it. And there's not someone else in there. But there are benefits to both of these, right? To where if you're trying to grow rapidly, if you're trying to get out ahead of the competition, or there's new regulations that are coming into your community that you have to buy new equipment, these are two really good options. But angel investors, you still have to pay them back. So whether that, and it's not, there's not an end date on it. So if I gave James that 5%, he doesn't go away unless I buy him out or there's a legal dispute and he goes away. So that essentially means that 5% of my profits every year is going to go to James for the rest of the company's life. Which there's huge benefits in that sometimes if you continue to grow and they're bringing more to the table than just that working capital or that money, so that you can grow. But there's also downsides to it, because then you're legally tied to them. I always say that when you take on an angel investor, it's like you're marrying a business partner. And so you have to make sure that, hey, if I'm going into business with this person, are we going to always agree? Are we always going to go in the right direction? Because even though they own a small percentage of your company, they still own a percentage of your company. So they have a voice in what you do. So always keep that in mind. I know it's a lot of information to take in. So if you guys have any questions whatsoever, feel free to schedule a time with us, comment below, or send us an email, and we'll do everything we can to help you out. All right, guys, have a great day.